Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers that I need to show you and you can read through. We'll just run through some of the key objectives of the webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These themes can be stories or narratives that can be long-term fundamentals or short-term themes even that increase or decrease in importance over time. So this week we'll look at the push-pull, if you like, that we've mentioned before, the game of cat and mouse between what markets are oscillating between inflation and growth. And we'll check out the VIX, so the volatility index, and the chart for the US 10-year Treasury yield, which is governing a lot of price action in the US dollar. And we'll also then check in with the S&P 500, which is a gauge of risk sentiment. We'll then do our usual review of the biggest risk events in the last few days and week or so, that being non-farm payroll, of course, from Friday. And we'll check out some of the majors which have been impacted or not, actually, in the case of the euro dollar. We'll look at, and also dollar yen, which potentially moves. It's highly correlated with the US 10-year Treasury yield, and therefore the main event of this week, indeed probably this month, which is today's US CPI figures up in a couple of hours. We'll preview that, and then we'll finish with a look at sterling. The Bank of England meeting last week was key, so we'll look at sterling against the dollar and focus on the impact of that Bank of England meeting, and potentially also then euro sterling as well if we have time. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please ask them along the way, or at least at the end if you like, and we'll try and answer those as best we can as soon as possible, or probably after the webinar finishes. We can get in contact with you and we can talk through what you may need some understanding on, or just a run through of some of the events or price setups even on charts that you would like to go over again. Okay, it's Wednesday, August the 10th now, just after 11 a.m. in London. So let's now get to the first chart that we want to tell you about, which is the VIX. Generally, let me just check out a couple of things before we get to it. So yes, the VIX. Generally, yeah, markets have been pretty quiet this week, actually. Ranges have been fairly tight, with summer flows really what we would expect at this time of year. European traders especially are running pretty flat trading books during the holiday season. So that means volumes are historically a fraction of the size really of normal trading activity. And that means potentially markets are slightly more whippy, if you like, more choppy in this environment, as there's less volumes, low liquidity, and then volatility can pick up, which leaves us kind of head scratching sometimes for reasons as to why the market has moved. But a lot of the time, especially in these summer months, a lot of the time in the summer, it's just because of this low liquidity and low volumes that we have. Of course, we have the upcoming US CPI report, probably the biggest risk event of the month, which could potentially spark some volatility. But the trendless environment for the dollar especially, that's been noticeable over the last few sessions for sure. And if we look at then the volatility index, the VIX, so that's known as Wall Street's fear gauge. You can see a chart here actually, which is the daily, but I just want to show you the weekly first of all, and you can see The long-term average generally is always given as around 20 or so. Anything above 30 means we're sort of much more elevated with volatility, and there's quite a lot of fear generally in the markets. Let me just mark on sort of the 30s around there. So you get these spikes through the months where we spike up through there. There's a lot more volatility in risk assets, and then we sort of tumble down. And you can see the last few weeks we've actually had 7 consecutive weeks of very narrow falls there. So quite interesting sort of action, price action. Probably interesting, not really the right kind of word, as it's been quite quiet. And we haven't had actually 7 consecutive weeks of these narrow falls since November 2019. So post sort of pandemic, still in that sort of phase of quite high fear. So we're sort of back to now the sort of 22 level near the long-term average. And you can see these SMAs here, the light blue, the black and the gray lines. That's the 50, 100-day and 200-day moving averages. We don't oscillate a lot around those, but you can see we're now sort of bang on them now. So interesting potentially to see what happens, whether we just continue to drift low until we sort of probably get everyone back to their trading desks in September, or potentially have a spike higher from these sort of lower levels. I think over this time frame, really, it has been this case of this investors really shifting back and forth. So this game of sort of cat and mouse, as I've said it, if you like, between worrying about inflation or growth. So when incoming data points to a resilient economy, the pendulum then swings towards inflation, and traders price in faster Fed rate hikes generally and central bank rate hikes. And then when the data disappoints, recession concerns dominate, and the Fed tightening sort of gets priced out, basically. And if you like, that's this classic case of bad news is good news in effect. So data is poor. That means the Fed won't hike. Recession fears, the Fed won't hike as much as potentially as thought. And that's good news for risk assets. And until recently, for sure, recession fears have been winning this battle. We've had a bunch of leading indicators such as business surveys, housing, inventories, consumer confidence, and also that the or the headline grabbing inverted yield curve that has all been warning that a downturn is imminent. And that has led previously in the last few weeks to that quite sharp decline in US 10-year yields. I'll just pull up the charts of those yields here that you can see there. And you can see, yes, we dropped down in that 10-year yield down to the crucial key psychological, really, 2.5%, having sort of got very close to 3.5% back in mid-June. We then spiked, drifted lower, spiked then down to 2.51 it was actually, so very close to 2.5%. And then we sort of moved just a bit higher then to sort of around the 2.7% mark on the two. This is the 10-year US Treasury yield, very well watched benchmark for global rates. And during this time, the S&P's gained, last week it gained around 0.4%. The NASDAQ as well was up 2.2%, and that's the first time actually since the start of April that both indices have made 3 straight weekly gains. As far as stocks go then, let me just grab the next chart. We want to pull up the S&P 500. We normally look at this on the weekly, and generally US stocks, if you're just going back, actually, if you remember that July was a stellar month, S&P 500 up 9.1%. That's the monthly chart there. You can see that massive move, reversing most of June's move. We're up, as I say, 9.1%, making it one of the best months ever, the biggest monthly gain since November 2020. And really, just recapping on that, the reasons for that was obviously the Q2 earnings results were really not as bad as some had feared, and especially with some of the big tech names, the mega caps, Microsoft, Apple, Google, or Alphabet, really its parent, all issued more confident outlooks than investors had expected, and that really has lifted the US tech sector, which of course has an outsized weighting really on global markets. And the Nasdaq actually fared even better than the S&P, if you recall, up over 12%. And really then quite a nice positive surprise from Q2 earnings, really, and that season now winds down. I think we have Disney today, but otherwise, yeah, one factor in this reversal, this positive big reversal in stocks in July, probably the main driver of stocks, and we've alluded to it looking at that 10-year Treasury chart when we dropped from 3.5% down to virtually 2.5% on that 10-year yield, was really falling interest rate expectations. And the central issue is that potentially going forward, that we've talked about before, yields are now pushing up again. And if inflation remains elevated, which is what we've consistently been saying with the Ukraine conflict, especially rolling on, then potentially you've had those yields push higher, and potentially that impacts on stocks going forward. For sure, every bear market, we should realize, has strong rallies within it, and certainly now we're in one of those periods probably where it's quite tricky, or there's a lot of speculation about whether we've seen this low in stocks or it's just a rally within a much broader, larger bear market. And July's strong performance, of course, contrasts quite starkly with the first 6 months of the year, when the S&P fell, of course, over 20%, 21%, Nasdaq plunged 29%, and that was the worst half performance for US stocks in more than 50 years. So technically, yeah, we like to start with the S&P 500. The weekly chart here, you can see that bear channel break, the bear channel, of course, getting down through a long-term fib level, a 38.2 fib level at 38.15, breaking down through as well that mid-May low at 38.10. So sort of support, or sort of support, then term resistance. We dropped down to 36.36 really was the low. Didn't get to the 200-day moving average. That's that black line, which was around 3,500. So we sort of pinpointed that level over the last few months, actually. And then we didn't get to that level of 3,500, and we've oscillated then around this 38.15, 38.10 level, and then pushed higher with that fall in yields, and even broken this sort of bear channel that we've marked on here. I've got the wider fib levels there, so the next fib level that we get to is 4198. That's the 23.6 of the all-time high down to the pandemic low. And then this grey line is the 100-week moving average at 41.41. So we're just trading below there. If we go to the daily, probably more interesting for some of us. You notice actually I've put on these other little indicators here, this just being consecutive days up or down at the bottom one, and then this one is percentage change, which can be helpful, of course. But if I just take those off for now, this is the RSI. You can see this breakout then of this bear channel. Some people just have a trend line from these highs and the break sort of around here, and then around the 50-day moving average, which is this light blue line. But we've broken above here at least. We've put on this the late February low of 41.14, and then we're oscillating now, really trading around here, around then the 100-day moving average, which is 41.14, and we're just trading above that for the moment. Really interesting sort of juncture that we're at. I then marked on some other fib levels, so that's from, let me just show you actually, yep, so there's the fib levels from that March high down to the June low, and you can see these Fibonacci levels here. We're trading around the halfway point of that move, so that's at 41.37. So that can act as support as well. So quite a few levels of support here potentially. So if this is bullish consolidation of this move from these June lows up, it does kind of look like bullish consolidation, then potentially we need to move above 4,200 and that long-term fib level up towards potentially 42.55, which is a 61.8 of this move from March down to June. So yeah, levels to look for on the upside. The black line there is the 200-day moving average, very widely watched. That's higher again at 4,333. If we break down through that support, then potentially we get down to 38.2 fib is 4019, and then around 4,000 or so. So really interesting juncture really for the S&P on this support, whether this is bullish consolidation, which it kind of looks like, or if we break down through that near-term low 4079, then we're back down to 4019 and 4,000. Okay, let's review some of the events very briefly from last week's main events, if you like. The first one being US non-farm payroll for July. You can see here just updated a graphic which shows you really the main numbers to look at from that report. The headline number, of course, 528,000, really adding more than twice as many jobs as most economists had expected. The estimate was for 250,000, so that was the fourth straight month of a beat actually. And a real surprise really, following data on from vacancies and claims for unemployment insurance that had both suggested that unemployment was picking up a little, in fact. So really came as quite a shock. And you can see there 3.5% was the unemployment print, so lower than the 3.6 expected. I've put in the participation rate there, which actually slight decline, so minor disappointment potentially, but every other figure, wage growth here 0.5%, so really beating the 0.3% quite handsomely that was expected, and even the annual figures now above 5% for wage growth for earnings, and that was against the 4.9% forecast. And to illustrate some of this, well, I've put in 75 basis points there. We'll look at this shortly, actually, on the CME Fed Watch tool. 75 basis points now has risen to around 70% actually from when I wrote this, from 40% before the release. It was kind of 60-40, so 60 in favor of 50 basis point rise in September at the Fed meeting, and then a 40% chance of a 75. That's now flipped really and more to 70-30 in favor of 75 against 50 basis point rate hike in September. And then the year-end rate as well, that's gone above 3.6% now, I believe. From well below 3.4% at one point as a year-end rate. So what the markets think the Fed funds rate will go to, and this is obviously important in the context of today's US CPI data, and obviously then that drives potentially Fed rate expectations around this 75 basis point rate move, another one after the previous. And then also that dictates dollar direction, and then obviously all the currencies that we all look at. And I've put in there, well, payrolls, you know, still in the last 3 months have averaged nearly 500,000 per month. So really strong reports that we saw. I put in a chart here just to illustrate. It's from these guys, BCA Research. Actually, they offer the series of non-farm payrolls since the beginning of 2020, and you can show really it shows the total number of jobs is now back to pre-pandemic levels there. This top chart here, pretty much back to that. And the same is true of the unemployment rate as well, which you can see on the bottom chart there, a massive spike higher towards 15%, I think it was, during the pandemic, and then tumbled sharply and pretty quickly, really surprisingly quickly, if you think about how much fear there was in markets, in the economy during 2020. But then this sharp fall down, and now, as I said, we're back to pre-pandemic levels. 3.5% is actually a multi-decade low in US unemployment. Some of this, or especially the payrolls drivers, driven by that reduced participation rate. So that's a smaller proportion of the population seeking work, and that's showing up in the unemployment data. That goes around this sort of great resignation sort of phrase, which is still having an effect. Unemployment is well, especially in the leisure and hospitality sector, that still has some way to recover, and you can see that gap there that we probably are aware of when we go to restaurants, bars, and the struggle slightly to recruit people in that kind of sector, in the hospitality sector. But other than that, the jobs market has completely recovered much faster than most would have expected from sort of March 2020 or so. So clearly a very strong jobs report, and that's gone a little way to softening those recession fears and really giving more credibility to last week's pushback that we saw. Really important to mention from numerous Fed officials that really they were nowhere near done at the Fed in terms of tightening. And it now, you would think, it becomes easier for the FOMC to raise rates, because essentially if the employment market is still strengthening while inflation remains at its highest in decades, then it's really hard not to see why they shouldn't raise rates. And then we go on from that, the belief really in an imminent sort of pivot, if you like, that many people have used by the Fed away from raising rates higher, that's really taken a knock, that dovish pivot, if you like. Although we do know actually that the market is still predicting a rather more lenient Fed than it was in the immediate aftermath of the shocking inflation data from May, which was published in June, if you remember, and that's when we had a big repricing. If we just look at the Fed Watch tool, which I'll just pull up here. So this is the CME Fed Watch tool of where markets think Fed funds rates, the Fed funds rate will go to. We've used this many times before in this webinar. Hopefully some of you are using it now, and if you're not, then just check out this website here, CME Group, and really you get what Fed funds are pricing for each FOMC meeting. So the next meeting is actually not for 6 weeks, which is really important to bear in mind, especially with all this pricing going on at the moment. But we still have another non-farm payroll report, of course, at the start of next month, and then we have today's CPI and also another US CPI figure as well before we get to this Fed meeting. So that's really something to bear in mind. But yeah, back to this pricing of where Fed funds futures are predicted to go. Really, we can see, I think there's a further 125 basis points now of Fed hikes for this year. So potentially you can see in September, we're now, slightly below that 70%, 68% or so for a 75 basis point move, 50 basis point move, 33%. So I've always used the sort of 70% marker, if you like, for when the Fed likes to use as a gauge. So anything probably around 70%, which is priced in, certainly above, then the Fed really doesn't like to sort of shock markets by doing something with a lower percentage. But around that 70% mark, then they generally do go in line with market expectations. So that'll be really interesting. The 75 basis point hike, the jumbo size rate hike, is priced in currently, and the favorites. And if we just go down to historically, then you can see, a month ago it was half that, so 31% chance, pretty much 68% chance or so of the 50. That was a month ago. slowly rising. Even a week was only 43, as we said, 60-40 or so we mentioned. And then today, obviously, slightly backed off from yesterday, but around the 70% marker there. So really interesting to see what happens with today's data for sure. And you can see by year end then, markets above that 3.5% mark, really giving that the most chance, the most likely chance really of where rates go. As we said, that was from a lower level really, a lower level than seen recently, where sort of that end rate for the year end, if you like, was sort of 3.3% or so. So now we're sort of 3.6%, I think it is, if you'd price it in properly. As I say, then we get actually get cuts in the market pricing in around 50 basis points of cuts from the summer of next year. So again, really interesting to see how that develops. For the dollar, let's just show you the DXY charts that we always like to look at. Which is here, and you can see, yeah, the DXY chart. We all start with the weekly actually. You can see obviously the strong uptrend. You can see that trend line support then, and then some support here around the mid-June high at 105.78. If we then drop down to the daily, you can see much better than that trend line support, really holding prices as they sort of push off the lows, which were around the 106 level or so. So key psychological sort of support there. Also that light blue line, the 50-day moving average, has held as quite decent support this year or so. Again, doing a job. And that comes in now around 105.53, 105.54. That's the 50-day moving average. So potentially around here, 106 level, and just above 106.11 then is support, although we're just coming off slightly over the last couple of days, but we're really waiting for the data for today, which potentially sparks some volatility. It really interesting as well. We think that the dollar really sort of didn't lose its shine too much, did it, in this repricing around the Fed, and that sort of resilience then kicks back into safe haven flows. A lot of tension around Taiwan at the time, last few weeks or so, but the dollar acted as a safe haven and picked up on demand from buyers. And also as well, if you think there's a genuine sort of lack of alternatives, with Europe especially being certainly in worse shape, potentially in recession, of course, with this energy crisis looming for the winter months ahead, and then has been lurking for the gas crisis for several months. And what this dollar dynamic, if you like, just touching on that, then the strong dollar dynamic, really that won't change until the economic outlook for the rest of the world improves, and then capital starts flowing out of the US. But until that time, we're probably not there yet. And but we have had glimpses of it. I think it's worth pulling up a chart we don't look at that much. This is Brent crude, so oil. We've had, as I said, a decline in some of these prices, and that's a good start, but it's really not enough just yet. I think technically it's quite interesting, this Brent crude chart, basically. So we've got quite strong level of support around sort of 92 area, just above 92. If you see here, we go back. It's been quite marked. You had that spike low in July down to 92.38, and then you've had sort of that finding support again over the last few days. We're capped at the moment. This dark black line is the 200-day moving average at 97.34, always widely watched. So that is capping, that is acting as resistance, whereas it did as support. We then broke down, and then it's now resistance. So potentially, if we do roll over again and we do break the sort of 92 area, then potentially we do go quickly to 90 or so. So we think that's worth probably keeping an eye on. Right, let's get to the main event of the week, which is the US CPI figures out shortly in an hour or so. Remember that the FOMC, of course, the Fed is now heavily data dependent, and that certainly doesn't go away with this key release. And I'll just pull up actually where expectations are, in fact, and just show you those, because they are key for expectations, of course. And you can see on this chart really where we are currently, around the 9.1% mark last time, and then expectations on various surveys, all pointing to a lower print in the headline. That's expected to print at 0.2 month on month in July, and that's easing back from 1.3% from the monthly place in June, really. And that pullback on a month-on-month basis is, of course, after these sharp energy-led expansions of May and June. And the 0.2, that would actually be the smallest monthly increase since January 2021. And see, then that would push the annual inflation rate slow to 8.9% from that previous 9.1, as I said. And you can see on this chart, all the surveys point to economists really expecting this slowdown, is certainly in the headline print. So 8.9% expected, but the core, so that's the index which strips out volatile food and energy, that is expected to continue ticking higher with a 0.4% month-on-month gain, and certainly housing costs are continuing to boost that index. And then for the monthly, then that for the annual rate for core, that should stay near around the 6% mark, consensus thinks, and that certainly will focus the minds of Fed officials. Touching on, so there's two different issues here really, and it's whether the market decides what's more important. So whether the headline, which is falling, or the sort of strong and quite sticky core inflation, really what is more important. For us, it's probably the latter, but certainly headline inflation, or there has been credence to the forecast for a possible peaking now in the headline, especially. We've seen business surveys like the S&P Global Composite PMI, which have recently showed that companies raised their selling prices for the slowest pace since March of last year as demand falters. And then we touched on oil, commodity markets as well. They've all added weight to this potentially slowing in prices, with everything from gasoline to food prices really rolling over more recently. And also, we also note the headline inflation rate that has shown a tendency to surprise on the flip side, actually, to the upside. And we've seen the last 5 of the past 6 releases have actually surprised to the upside. So really interesting report coming up. A surprise of similar magnitudes to, say, the non-farm payroll on these July numbers. That would probably have an even bigger impact really on rate expectations and on yields, and so the dollar. If you think so, a negative surprise on inflation, that reveals prices rising faster than expected. That should potentially have quite an effect on stock prices now, which has sort of been slightly immune to this, and especially growth stocks and tech stocks, which have enjoyed really a near 20% rally from their lows recently. So potentially much faster prices, or rising faster than expected, will have an effect on shares, of course. While if the core metric surprises to the downside potentially, then certainly many strategists will be out on the wires, potentially dusting off that argument and finally being vindicated, if you like, that core consumer prices have peaked, because certainly we've seen a lot of voices calling for that to happen over the last few reports, but they've surprised, as we said, on the upside. But if that does happen, that we do see this fall, then potentially of course, that helps the Fed move to smaller rate hikes, potentially at its set meeting, and no doubt potentially hurts the dollar as well. In short then, a big downside miss keeps just the 50 basis point option open, and then the dollar will get hit, will get sold. A consensus probably, or a bigger number than consensus thinks, will likely lock in that 75 basis point move in September and see the dollar go higher, we think. But as we say, there is this sort of argument discussion around the headline moving slightly lower against the sticky core. The other US release we think worth paying attention to is the consumer confidence data that's released on Friday in the form of the University of Michigan sentiment index. It's plunged really as the cost of living crisis and falling equity markets really have hit spending power and confidence. However, it's gasoline prices really, which will have an impact in the headline CPI and have an impact potentially in the sentiment index. They've dropped now from, I think it was a national average around $5 per gallon in June. Now they're closer to $4 in early August, I think. That's $4 or so, $4.15, I think, per gallon. And that really should provide some relief and support. And if we just think of the previous report in this Michigan sentiment survey that showed US consumers in July lowered their views of where inflation was headed as well, and that really moved markets. I do remember on the Friday, respondents to the survey had indicated they see inflation in the next year easing to a rate of 5.2% from the previous June expectation of 5.3, and that was actually the lowest one-year price increase expectation since February. So while that decline may provide some comfort that inflation expectations have not become unmoored, certainly we do have to remember, of course, it's still way above the Fed's goal of 2%. Otherwise, things to look out for on the calendar, on the wires really, is our Fed officials who will be speaking potentially after the CPI report. We have Evans, the Fed's Evans and Kashkari. They're due to speak today, and then Daly is speaking tomorrow. And they really sort of have reversed that sort of dovish pivot, if you like. Last week especially, we had those two speakers, Evans and Daly, saying that the work was not done, as we've mentioned. So we also get potentially unscheduled speakers likely to conduct impromptu interviews. So really probably quite important to look out for the headlines and potentially what these officials, these Fed officials, are saying. They may give clues to the clues for their appetite for another 75 basis point move is basically what everyone's looking at in September, and then really to see how high the Fed is willing to go and for how long. And it's really interesting. We're getting some Wall Street strategists, I think from Citibank, suggesting 100 basis point move is really on the table if the CPI report today comes in a lot hotter than expected. So interesting report at 1:30 UK time. If we just have a look at some of the majors that potentially will be impacted by this report. So we've got, let's look at euro dollar first of all. Well, sadly, it's still stuck in this broad range, so sort of 101 to 103 range, been stuck in that, I think, for 15 sessions now. Yes, not a lot going on in euro dollar at the moment. Certainly a drive towards 102.50, and then the high is actually 102.93. That sort of, or that could provide some excitement that we're going to break higher. But really we're trading sideways. Near-term support is the big figure, 101 for good order. I think the bottom of the range, 27th of July low, was 100.96. As I said, the top of the range 102.93, so 101, 103 range. If we do break out then higher to the upside, this is sort of stabilization of the long-term downtrend, then we have that 103.41 level you should all be aware of. Going back to 2017, it's also the mid-May low around there, 103.48. And then you also have the 50-day moving average again, you can see, which acted as resistance. That's now 103.42. And then the downward trend line, so trend line resistance just above here. So whole zone of resistance if we do get the breakout. Otherwise, yeah, a move to the downside is if this is just bearish consolidation and then we get the breakdown lower through 101, then we obviously get towards parity, which is what a lot of Wall Street analysts, strategists, FX strategists are looking at. The low 99.52 we got to. But we would note, of course, the more we trade in a tight range, consolidate, then historically, then you do see when you do get this breakout, do get range expansion, then that historically is to in line with the long-term trend, and that long-term trend is bearish. So 101, 103 are the markers. I haven't had a lot of euro news. In fact, if we just touch on that, we had Moody's recent downgrade of Italian sovereign debt, sovereign outlook, but that really didn't move the needle at all, as you can see. And of course, the gas crisis that rumbles on. Obviously, massive fears around Europe, the continent coming into the winter months, and potential issues there around rationing and so forth. The other major probably should touch on with US CPI for sure coming up is dollar yen. That's really worth looking at because it's very highly correlated with 10-year US Treasury yields. That's why we showed you that chart earlier. Similarly, came off the highs 3.5%. In dollar yen was 139.38, put down US 10-year yields to 2.5%. Which we came down to 130.39, you can see there. And the 100-day moving average, that's that light grey line, 131.12 now, but it was lower around that level actually, and we bounced off there nicely. We also bounced off this marker here that we've put in, the May high at 131.34, you can see there. So we bounced quite nicely off there as yields are pushed higher and the dollars gained in strength. We're now coming up to a really interesting juncture, actually around 135, sort of psychological level as well as a long-term level from way back in March 2002. That was at 135.16. That was the top in March 2002, and we're just sort of struggling around there now with a 50-day moving average, like blue line at 135.21. So I'd see this as bullish consolidation before we break higher. Really looks like tight couple of days, and then potentially we move above here towards towards sort of that high there, 137.46 and above potentially, but all depends really on the US CPI number. I did say we'd look at sterling very briefly and cable, but if we just recap the Bank of England meeting last week, really important meeting, really quite a surprise that a major central bank comes out with the language they came out about predicting a recession and the negative growth that potentially we're going to see in the UK. I'll just pull up what Bloomberg handily showed us, which was this graphic here. The Bank of England, yes, they predicted that we would see 7 straight quarters of negative growth, and that's when imposing market implied rates in its projections. I'm really suggesting the UK is in for a really grim time. Along with inflation, then the bank sees at topping around 13% in the fourth quarter of this year. That comes amid that increase in the energy price cap and really remaining, the bank thinks, at double digits until the third quarter of next year. And the bank, of course, they met expectations with a 50 basis point hike last Thursday, and they also pointed to another 50 basis point increase at September at its meeting, even as it predicted this truly miserable outlook really for the UK economy. And of course, that's meant to really quite heavily depress household spending, real incomes, and pretty much keep sterling on the back foot against its peers really over the foreseeable future, you would think. We do get growth data, preliminary growth data for the second quarter on Friday. The Bank of England projected a contraction actually of 0.2% for this quarter. And a contraction is widely seen due to, well, that's widely seen, yeah, due to the extra bank holiday for the Jubilee in June, really, is the reason why. But the weaker activity really will highlight the Bank of England's call for the UK to enter this recession in the fourth quarter of this year, and then contracting potentially by around 2% over the subsequent quarters. If we then just look at cable as the next chart to finally look at, which is here, similar to, in a way, euro dollar, so long-term downtrend, obviously dollar strength capped by trendline resistance, and also then the 50-day moving average that comes in at 121.47 at the moment. We're trading below there and just around this trendline resistance, having topped out recently at 122.93. So sort of, yeah, levels of resistance just on and above here now. We've also marked in that mid-May low at 121.55 potentially. So long-term downtrend, if we do break last week's low, I think was just above 120, then potentially we'd get down to this level here, 119.33, which is the mid-June low, and then we're looking sort of levels around 118 potentially. But a lot to play for, a lot to look at, and certainly a lot may be decided by the US CPI data this afternoon. Okay, we'll wrap it up there. Good luck with your trading. Remember, it's summer markets, so low volumes potentially means quite whippy price action, and especially with this risk event in a couple of hours. But good luck with the trading, and please tune in back in a couple of weeks' time when we have our next webinar. Okay, thanks for tuning in and listening.